Good morning from our world headquarters in New York. I'm Menace Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
President Xi vows to take heartwarming steps to attract foreign companies, while President Biden says much of the world's history in the coming years will be written in Asia. Oil sinks into a bear market, crude collapses on signs of healthy supplies, rising stockpiles offsetting the Saudi and Russian efforts to keep declines in check. And the chip war spurs breakup rethink at Alibaba as Applied Materials faces a U.S. criminal probe for allegedly violating export restrictions to China. A very good morning. There are cracks in the global data structure, from the UK retail sales to the jobs data in the United States of America. And this is the repercussion. 5 days. It's a bit like running with the bulls at Pamplona. That's what this bond market really feels like. 26 basis points in the space of 5 days. And we're not done yet. As I say, the question is, how much more momentum will you have in this bond market? We're at 4.39% at the moment. We give a couple of pips back. It is 26 basis points for the week, and it is those cracks in the data. The jobless claims, the highest in 2 years, rising for an 8th week in a row. Home builder sentiment, that's tracking the lows of 2023. And Bank of America in the flow show the first glimmers of outflows since February 2023. Now, when it comes to the money markets, we'll talk about those a little bit more detail. There's 5.73 trillion going into money market funds. On the oil market, we're bouncing back from this implosion. We were down over 5.6% yesterday. 4th week of losses, depending on what we can put on the board today. I mean, we are gripped. This market is gripped about what happens in Vienna in 10 days' time. We're down 20% from the highs. Did the algos really trash the market? That is going to upset the Saudis, because Prince Abdulaziz bin Salman, he loathes the speculators, of which algos are a part of. Goldman Sachs, of course, warned that there's a lot more flow coming from non-OPEC, and that is delivering an exaggerated negative sentiment. Now, when it comes to the pound, we're flat at the moment, but again, it's the cracks in the data that I bring you to. Retail sales unexpectedly fell by 0.3%, and a massive revision to the previous month of 1.1%. So we're seeing these bunds and bonds all move. Danny, good morning.
Good morning, Manus. And it's a week where we just had to bow to our robot overlords, because it wasn't just the algos and oil that apparently shook things up. In this equity market, Goldman Sachs says that the CTA, so the momentum quant-type traders, bought a record $7 billion worth of American equity over the past 10 days. The gains continue, at least for S&P 500 futures, up 0.2% today. They were slightly higher yesterday, on track for a 4th consecutive day of gains. NASDAQ underperforming, basically flat at the moment. It's those concerns about chips. $20 billion wiped off of Alibaba yesterday in the pre-market session. Applied Materials, that is falling, weighing on the index over reports of a U.S. criminal probe. And finally, Manus, European stocks, those are moving higher by 1%. We've talked a lot about how American stocks are taking heart in the fact that cuts are priced in. The same is happening for Europe. We have now priced in a full percentage points of cuts from the ECB for 2024. But Manus, when we talk about the flows and where the money is going, it is remarkable to see the amount of money being poured into equities. At the moment, the S&P is on track for its best month. It's added $2.8 trillion in market value over that time. The flow show, just out from Bank of America, said that this past week, U.S. stock funds, global stock funds rather, have seen their second best inflow of the year.
Yeah, I just want to come back as a CTA. Goldman's are saying 70 billion went in. I mean, I want to reincarnate myself as many things, a junior banker being one of them. But what 70 billion bucks went into the CTAs? That's in the last 10 days, the largest on record. So where do you want to hide? Money market funds. I can't open a money market fund. I do not exist in this country. I am trying desperately to open a money market fund at one institution. Have a look at this. This is the flow of money in terms of the flow into money market funds. 5.73 trillion, nearly 22 billion went in last week. So what you got there, Danny, is a monster move. I've not participated in that.
I feel like you're Vanna White right now. You talked about the chart and it appeared in front of you, and I even did like the hand motions. I don't know why I did that.
That wasn't supposed to go that way. But anyway, we got to Friday. We didn't break anything. The question is, what happens with the bond market? That was very well done, Danny.
Thank you. Thank you. Do you want to buy a vowel?
I just want a money market fund account open, really, to tell you the truth. If I can exist in the USA, we'll make progress. Let's move it along. PIMCO, they're anticipating another corner of the market to do well. They're renewing their bullish bond forecast for the new year, writing, quote, current valuations and an outlook for challenging economic growth, diminishing inflation. We believe bonds are rarely appeared more compelling than equities. Geraldine Sundstrom and the team at PIMCO put the note out, portfolio manager. Now, Geraldine, what goes through Danny and I's mind? We were looking at this marvellous quote. We know that you've said this before at the start of the year. It didn't go so well. But what kind of hard landing do you need to see to deliver that outperformance of the bonds to equity spread? Good morning.
Good morning. Well, we don't think that you need a hard landing at all. The best predictor of bond return is the current yield. And at the moment, with yield where they are, even out on the belly of the curve in the US or other countries in Europe, the expected returns are looking good. If you have a bit of a harder landing than the market is pricing, then those returns will be even higher, whereas equities, where the equity risk premium is at the moment, will struggle to beat those type of returns. So, and even if inflation were to be quite sticky, you have quite a lot of protection for higher yield embedded with this type of carry at the moment.
Well, you're talking about the equity risk premium. If stocks are going to struggle, Geraldine, in 2024, just how bad does it get?
We don't think there is going to be a hard landing. We think there's a sort of a toss of a coin if we get a recession or not in 2024. So we're a little bit more cautious than consensus out there. Yeah, so I think actually, I forgot your question. I'm sorry, it's Friday.
Geraldine, honestly, I do the same thing all the time.
Day.
Don't tell Manus. Don't tell Manus. Sometimes he says stuff to me and I've forgotten what he said. But I wanted to know specifically about stocks. In these two scenarios you've laid out, and necessarily we don't get a hard landing, maybe we do, it's a coin toss. How ugly does it get out there for stocks if we do get to that hard landing?
No, I think so. Earnings expectation for next year are still quite elevated. I mean, earnings see some acceleration of the economy, which is a sort of dichotomy versus our expectation of growth slowing down. So we think we're going to continue to see disappointment in terms of earnings consensus next year. That said, you know, it's not a hard landing. If there is a recession, it's going to be a mild one. But you could definitely see a correction. Multiples are pretty elevated, especially with the Magnificent Seven. There are other markets which are much more fairly valued out there. And it's hard to see this market with like a really big broadening rally beyond some secular area or tech-related area that are still seeing a lot of growth. So we're cautious, but we're not calling for a crash of the market.
Okay, so maybe a correction, a little bit of pressure on stocks, no dramatically hard landing. So let's translate that into credit. You're quite bullish on bonds. We know that, the belly of the curve. We got that message loud and clear. Let's talk about the probability. Late cycle is where you say we are, 50% probability of a recession. If we are late cycle, and Danny and I were chatting about this yesterday, we looked at Moody's this morning. They say speculative corporate defaults are running at 5%. Now, that's the highest since 2021. What we want to know is what kind of default cycle are we going to get in 2024? Where is that going to be most pronounced in terms of the spreads? Do we blow out? And how aggressively do we blow out?
So we really recommend to go up the quality, be it in equities or credit. And steer away from the more cyclical, much more interest rate sensitive sector, which could have a hard time. The good news, though, is that during the very low interest rates, companies have turned out their debt pretty far out. So the wall of maturity is not necessarily going to come right here, right now, and is going to be much more gradual, especially towards 2025. So there's not necessarily going to be a big credit cycle like we're used to. Companies have been very clever during the very low levels of interest rates, but that's not a recommendation to go for junk credit. We really stay in securitized part of the credit market, high quality investment grade, and certainly not in sectors that are very sensitive to interest rates.
Geraldine, it's been a year of a lot of soul searching for the bond bulls. I know PIMCO and your team were among those that said bonds are back. You're not the only one. A lot of people got this wrong. Where did that soul searching lead you to? What do you think's been the biggest miscalculation this year?
Well, I think the transmission of monetary policy probably did not work as we thought. There was a lot more structural savings that were there, so the consumer was very resilient, mortgaged or very fixed rather than floating in many economies. And so we feel it's much more like the delay, things taking longer to happen because of the series of supply shock and demand shock that we have. But eventually, as time goes by, we do see things roll over. And of course, when you look at Europe, you see that we are flirting with recession, that you see the data in the UK this morning. Those economies are a lot more sensitive to interest rates, and we see the result there. So the US has been a bit of an exception out there, but as time goes by, we will see where the convergence occur, and we would think that the convergence is more likely to be towards more slowing in the US than acceleration in the rest of the world.
So, Geraldine, I mean, you've touched on the big news points this morning. Slowdown in the UK, jobs data in the USA rising, but you are underweight duration in Japan. I'm just trying to close off this conversation this morning. I could be long the belly in the US, I could be long gilts, or I could be long of Japan. Where are you materially changing your allocation? Is it the big bond event that we're all anticipating in Japan? Your call across the three assets this morning?
Well, we think that the risk-reward in Japan, given the low level of yield, given that the yield curve control has not really been dealt with, is rather poor. So we prefer to be in those areas that, should there be a harder landing and consensus be wrong, you actually do get protection. You do get diversification in your portfolio. And you can find this a lot more in the dollar block. That could also be countries like Australia, which are, in our view, more sensitive to interest rates than the US in terms of an economy, or the UK for that matter. And a bit, willing to go a little bit out on this curve because you don't really lose so much. The curves used to be very inverted. So going out, in the belly of the curve was a costly exercise relative to money market.
Right.
But these days, curves are a lot flatter. So it's good to go out on that curve, get the real protection, because in money market, you don't have this duration, you don't have this lever effect that will protect your portfolio.
Maybe it's protection myself. Yeah, I can't open the money market fund, Geraldine.
I was going to say, it's good news for Manus because he's been struggling. The U.S. literally doesn't recognize him as a whole human being. It's very sad. Geraldine, I'm afraid that's all we have time for. Thank you so much for joining us on this Friday morning. Enjoy your weekend. That's PIMCO's Geraldine Sundstrom. Now let's get to some other top stories that are trending on the terminal this morning. International pressure on Israel is growing, with the U.S. and its European allies pushing a peacekeeping plan. This after Prime Minister Benjamin Netanyahu says Israeli forces have found a Hamas command center under the Shifa hospital in Gaza City.
Walgreens will close most of its stores and pharmacies on Thanksgiving Day. That will give thousands of workers an unexpected day off amid walkouts and layoffs.
Bloomberg has learned that Apple has fallen further behind in its multi-billion-dollar effort to make a modern chip for the iPhone. The company will likely miss its 2025 goal to roll out its own cellular modem as it struggles with the complex process of replacing the current Qualcomm technology.
Okay, well, we won't get dragged down in the Apple experience I've had this week. Coming up, we will delve into the fourth week of losses, sinking into a bear market. We discuss the ramifications for the OPEC meeting in Vienna, right here on Bloomberg.
Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Now, oil is headed for a fourth weekly loss. It sunk into a bear market, getting beat up yesterday, falling by nearly 5%. Joining us now is Bloomberg's Will Kennedy. Well, I told you this during the break, and I feel like I should just let our audience know this, too. When I saw oil price this morning, I phoned up Manus and I said, what happened? And he told me 5 different things, and I've forgotten them all. So what is the biggest reason that oil moved?
Well, what we had yesterday is we had a small uptick in inventories in the US, and I think that triggered some selling and clearly accelerated. Whether that was algorithmic sellers, as some people were speculating this morning, I don't think is necessarily totally clear. I think there is a bigger picture here, though, which is the market is adjusting to the fact that while demand has held up very strong this year, supply has also been very strong, and we've seen oil from shale more than people expected. We've seen a lot of oil from Latin America, Guyana and Brazil, and Russia is exporting quite strongly, and so that demand has been met by supply, and it's putting prices under pressure.
Well, good to see you this morning. I mean, I watched Amos Hochstein with Anne-Marie, and he really sort of tried to back, oh, Venezuela supply, Anne-Marie, it's really not that much, relative to where it was. And no, we're not going soft on Iran, Anne-Marie. You could hear the White House narrative trying to push back. They want low gas prices. They want lower prices. I'm just wondering how much of a juxtaposition we face as we go to Vienna, which is the Saudis and the Russians committing to extending their unilateral cuts to the end of the year. Is there more pressure now than ever, Will, to see something extended into Q1 2024 when we're in Vienna next week?
I mean, that's absolutely where the conversation is headed, Manus. Do the Saudis keep those voluntary cuts into 2024, and how long? I think the market expects them to do that at this point. The Saudis, to be fair, haven't said anything about it, but I think a lot of people in the market have been saying they expect them to do that, because when you look at the balances for early next year, they need to do that if they want to keep prices close to where they are now. And then the question is, for how long do they have to do it? And I think that's really going to be the focus for the OPEC meeting next weekend.
Beyond just the supply issue, and when it comes to OPEC, how much of this is about demand right now, Will?
Yeah, as I said, demand has been very robust this year, and a lot of that has come from China, because this is the first year that China's been out of COVID. So you've seen an even healthier than normal uptick in Chinese supply. That effect won't be repeated, and of course there is concern about how strong the Chinese economy is, so you won't get that huge bump in supply, and there is a lot of nervousness about the economic outlook. Inflation is dropping, but it's a good thing, but does that signal a softening in the economy? How strong will demand be next year? The European economy looks quite weak, so I think people are assessing their balances for next year. The other point to make about OPEC is that under the current deal, the UAE will be able to put another 200,000 barrels or so into the market. So there's a bit more supply to come there. So people are really doing their calculations for next year, and they're seeing that the market doesn't necessarily look incredibly tight. And if you get softer than expected demand, then it might look even less tight.
Right.
Yeah, I mean, that really is the pressure point. Okay, well, Will Kennedy there joining us, our global head of commodities. Speaking of which, let's just check in on the price of Brent and WTI. As Danny was just saying, back in a bear market. Goldman Sachs are talking about the non-OPEC supply. Will chipping in on that as well. We're down 20% from the highs. We bounced back by over 1% this morning. Iron ore going actually, I mean, it's given a little bit back this morning, but on the week, we've had 4 weeks of gains. I mean, we've had a cracking run on iron ore.
I think each of the races has a different character, and they're very have characteristics which make them unique and special and all worthy. I do think Vegas is going to be unique in that it's a night race down the strip on a Saturday night. I think it's going to be iconic. The visuals will be amazing. And I am not worried about demand because we have been lucky enough to see interest in Formula One explode here in the U.S.
That was Greg Maffei, CEO of Formula One's parent company, Liberty Media, speaking to Bloomberg. Manus, we talked about this race yesterday. It certainly has character, is one way to describe it. So I don't know if you saw this, because basically the race was happening when we were up in the silly hours that you wake up and I'm here in Europe. Because it's in Las Vegas, it was basically just happening. We had a practice run, and Manus, they had to stop it because a manhole cover came loose on the racetrack and damaged a car. Now, I'm not an engineer. I don't know a lot about setting up racetracks, but I'd assume you want manhole covers to stay in place. That seems like a basic thing. Yeah, well, you're just seeing massive gushers there of Las Vegas going up. Can you imagine a manhole projecting on a racetrack? I mean, this is a big moment for Liberty, isn't it? I mean, we were looking at some of the numbers. Yeah. I mean, they have sunk, quite literally, a monster amount of money into this. They've put $240 million into buying the land. What is it, 40 acres for the pit, the paddock at the track. I mean, they are knee deep in this to like $500 million in total. Yeah, I mean, look, they did tell Bloomberg they still think that Vegas is going to draw in the most revenue that they ever have for a Grand Prix. But I kind of can't help but wonder about some of the publicity that's coming out of this. You have the manhole cover thing, and then all over Twitter you have all these sports reporters posting pictures of empty grandstands. It seems like no one's really showing up as much as they usually do for other Grand Prix. Well, let's see what the stands look like in the final one. Then, of course, Aston Martin, age-appropriate car for somebody like me, I should say. Not on the racetrack, but it looks like they're going to cash in and sell $1 billion stake in the company. It is an age-appropriate car for me. It's a really good idea. I could definitely see you driving around the streets of New York, not in that car, but definitely in a street-legal Aston Martin.
You're welcome back. It's Bloomberg Brief. I'm Manus Crenny in New York.
And I'm Danny Berger in London. Here's what you need to know. President Xi vows to take heartwarming steps to attract foreign companies. Meanwhile, President Biden says much of the world's history in the coming years will be written in Asia. Oil sinks into a bear market. Crude collapses on signs of healthy supplies and rising stockpiles. It offsets Saudi and Russia's efforts to keep declines in check. And the chip war spurs a breakup rethink at Alibaba as Applied Materials faces a U.S. criminal probe for allegedly violating export restrictions to China. Well, the euphoria continues in this equity market. S&P 500 futures up 0.25%. The bots are buying. Goldman Sachs says that CTAs have plowed $70 billion into U.S. stocks over the past 10 days. That is a record. NASDAQ futures, those are a little bit weaker. I mentioned the Applied Materials story. We're going to get more on that shortly. That's also dragging down NASDAQ futures, which is why they're not up as much as the overall market. But this is a market that is hooked on the idea of rate cuts. Geraldine from PIMCO says we're not necessarily going to get a hard landing, but we still could see a correction in equities. We're far from that now, with European stocks, Manus, up more than 1.1%. Again, it is the rate cut narrative that seems to be fueling things. The ECB, traders are pricing in 100 basis points worth of cuts by 2024.
And, Danny, that 100 basis points of cuts from the market for the ECB is what's pumping up the bond market. But it almost feels as if, you're running with a bond. The bond bulls are almost like running through the streets of Pamplona. This is 5 days of the U.S. Treasury market. And as you can see, 26 basis points of a drop in yield and a rally in price. And likewise for the bonds this morning, you can see there a drop in yield, 252, 100 basis points priced in to Europe now. When you think about what happens next, PIMCO were very clear. They wrote the same note at the start of the year. Their natural proclivity is to be bullish bonds, but to be bullish the belly of the curve. 10-year paper at the moment comes back 438. It's a very, very clear break to the downside. The view is that you do not get a hard landing. You will not get a hard landing. That is not the thesis from PIMCO on the bullish bond note. When it comes to crude, we've just discussed it with Will. We're back in this bear market. A colossal amount of supply. Inventories in the United States of America. Additional supply from Venezuela, from Iran, from non-OPEC countries as well is building into the narrative, down 20%. Will Russia and Saudi Arabia extend the lollipop cut, that's the unilateral cuts, into the first quarter of 2024? Cable at 124.33. Your Christmas present is looking big, large, and very expensive. Good morning from New York. Danny.
Is it an Aston Martin?
No. It is not an Aston Martin. UK retail sales fell in the United Kingdom.
That's too bad.
We will not be getting you an Aston Martin. It's an age-appropriate car for me.
Yeah, fair enough.
Me. Can we focus on me?
No. Okay.
Thank you.
Yes, I'm sorry. I can't afford your Aston Martin yet. We'll talk about UK retail sales in a bit, Manus, but you were mentioning what we heard from PIMCO, this idea that we don't need a hard landing to see bonds outperform. In the credit market, I think this is fascinating. You brought up the stat from Moody's that they're tracking about 5% default rate in the American credit market. And Geraldine talked about this idea of being very active in the credit market, that you really need to go up, you need to go into high quality, because if stocks aren't going to do well, then of course credit isn't going to do well either. They're very correlated.
And they're underweight duration in Japan. And when we put it to the closing conversation of, look, where do you want to be longest? In bonds, in gilts, in Japan, where they have a lower duration, she prefers the dollar block. That's where she thinks that you are going to get much more bang for your buck.
Well, Manus, let's talk about the lack of shopping for presents for you here in the UK, because UK retail sales fell unexpectedly in October. It paints a bleak picture of the economy. Joining us now, not just wrap up that, but the global week that was in retail, because it was a big week, is Bloomberg opinion columnist Andrea Felstead. Andrea, why was this data so poor?
Well, I think it's a number of factors. The UK consumer has really defied gravity this year, but a few things are probably catching up. We've got the impact of interest rates. There's a little bit of concern that the jobs market's slowing. And there might also be another factor at play. You know, we all spend over the summer on holidays, concert tickets. Those bills all have to be paid. And just around the corner, you've got Christmas. So it's not surprising that shoppers really maybe sort of took a pause in October between those two moments.
Andrea, good to see you this morning. You know, I've been out and about looking for a few suits, doing a little bit of shopping. I've transferred. There are ticket prices write-downs everywhere here that you look on the kind of product that I'm trying to buy. Some TVs, some hard electrical goods, a few new suits. Now, they don't sell suits at Gap, but the quarterly profit there beat. And this is a win for Richard Dickinson. So what's going on there? Have they hit the right product at the right time for the US consumer? Because I think we've had various people come on and say, look, the US consumer will just spend right up until that last moment. They'll go hard and heavy on the credit card.
I think there's company-specific and broader issues. The Gap is clearly doing some things right after quite a few missteps. But what we've learned this week is that there are clear signs that the US consumer is cracking. Like in the UK, they've defied gravity. But we're just seeing little chinks that might not go on forever.
Is this not the worst timing for that, though? We're about to enter the holiday season, which is, you know, the holy grail, the thing that really makes the companies report.
Exactly. And I think we're going to have a real standoff this year, because the companies, one good thing is they've got rid of that mountain of casual clothing and kitchen appliances that they had after shopping shopping habits changed, that they were left with last year. So they haven't got to discount that. But clearly inflation for both food and non-food is coming down thanks to sort of lower freight rates, factory capacity. So prices should be good. But then consumers are really looking for bargains. And we're going to have that kind of standoff. And really, who blinks first shows what sort of Christmas we're going to have.
Well, we're going to get I mean, you never really get bargains in super luxury. I was just looking at this story. Gucci handbags disappointed at the auction. I wonder, is that like the canary in the global luxury handbag mine? But with that in mind, we often talk about aspirational luxury. I suppose maybe that's where a lot of us fit in. You know, the bag, the watch. I don't know whether $5,000, $6,000 watch is aspirational luxury or not. But are there cracks in aspirational luxury?
Yes, definitely. It has really been weakening. It started to weaken probably about a year ago, 18 months ago.
Yeah.
But it's really weakened this year. And it's not the super wealthy who are pulling back. It's the simply comfortable that maybe spent stimulus checks on a Gucci handbag, or they weren't doing other things like traveling, so they had money to spend on things. And all of those things are reversing. Plus, you've got interest rates, tighter credit. I mean, you've only got to look at the second-hand watch market, which has really fallen from its peaks, to show what is happening in that sector.
I'm in the market for a Submariner. I think I prefer that rather than the Gucci.
Not too shabby.
Yeah.
Are you what? You're going to get an Aston Martin and a Submariner, Manus?
I think I've gone
you're too
full
flashy for me. You're
middle-aged
leaving me in the
crisis.
dust.
No, the truth is, I think it's just a full middle-aged crisis. I think I want an Aston Martin. I've got a couple of watches. I'm grand. It's like, what do you do?
Yeah.
You know, but driving an Aston Martin in New York is probably a fool's game. We'll get a call now from Aston Martin PR complaining. Andrea, thank you very much. I'm still with the aspirational luxury. That is our Bloomberg opinion columnist, Andrea Felsted, on all things luxury. Let's stick with the earnings now. Alibaba tumbled after reporting results and announcing that it's scrapping the plan to spin off the cloud business because of restrictions on chips in the US. Who better to track the story than Tom McKenzie? He's way above aspirational luxury. He's prime British echelon, upper echelon. Good morning, Mr. McKenzie. Let's talk about Alibaba. What prompted the U-turn?
I'm going to take that and have that branded on a T-shirt, I think, Manus. Look, this is really significant. Like, you nodded to this, right? And this is the first time we've seen really consequential impact on the private sector in China as a result of the US restrictions on chips. Tencent have talked about the pain, but now this is a derailing of this restructuring that had led to actually quite a lot of investor enthusiasm when it was announced, splitting the business into 6 parts. They're walking back from this now, and that's precisely because the cloud business, this $11 billion cloud business, of course, it needs these chips to power that business. Those chips have become harder to find because of the US restrictions that were imposed about this time last year. Really significant policy there coming from the Biden administration. So Alibaba coming out with this big surprise yesterday. You've seen the stock down in Hong Kong today about 10%. They're not going to be spinning off the cloud business. They're not going to be spinning off their grocery business. And they face these challenges. Look, they've come out of this tech crackdown. They've come out of the post-pandemic re-changing of the environment. They're facing increased competition. Some of their senior leaders, the former CEO has stepped down. He was going to head the cloud business. So again, it came as a big surprise. The really consequential part of this is it is linked to those restrictions from the United States. HSBC putting out notes saying they still have a buy rating on this stock, but they don't see any catalysts going forward. In the near term, they say they're going to have to see the consequences of how they restructure that business. That's what investors are going to be looking at in the quarters ahead, even as they say that the valuation looks attractive on some levels.
Well, today's a really good example of how those U.S. restrictions are not just hurting Chinese companies, but American companies, too. We have this report of a U.S. criminal probe with Applied Materials. What exactly is that?
So Applied Materials is the biggest supplier of chip equipment, and the reporting suggests that the Department of Justice is scrutinizing the sale of some of this equipment from Applied Materials into the Chinese market. They have licenses. You have to apply for a license now if you want to supply much of this high-end kit into the Chinese markets as a result of those restrictions towards the end of last year. And the question then seems to be that the Department of Justice is scrutinizing whether or not indeed Applied Materials followed the letter of the law, got the licenses they needed to supply this kit. So it is a reminder that this is a two-sided impact to this. And it comes as you look at the big companies in Europe, like ASML over in the Netherlands. We know from our own reporting that their machinery, their lithography machines were used to produce the chip in the Huawei smartphone that caused a lot of eyebrows to be raised. So we'll see, I think, if that scrutiny from the DOJ expands beyond Applied Materials. That would be really consequential. But it, again, points to the fact that these companies are walking a very fine line.
Yeah, certainly. Tom, thank you very much. Looking forward to seeing your luxury T-shirt when you're next on with us. Tom McKenzie there. Thank you. All right, coming up, we're going to take a look at the week in politics. It's been a big one, from the averted shutdown to Biden's meeting with Xi. We're going to talk about all of it with Terry Haines of Pangea Policy on Bloomberg.
It's your Friday edition of Bloomberg Brief with me, Manus Cranny in New York. Danny Berger is still resident in London. Alphabet CEO discussed the importance of US and China collaboration when it comes to regulation and innovation with Bloomberg in San Francisco. This was yesterday. Take a listen.
It's not going to be easy, but I would start from this premise that AI will proliferate. So this is not the inherent nature of software. AI advances will get out to all countries. And so it is naturally the kind of technology, I don't think there's any unilateral safety to be had. We all have a shared incentive to solve for safety. You could have AI go wrong in one country that will impact every other country. So in some ways, it's like climate change in the planet. We all share a planet. I think that's true for AI. So now that you know that that will be true, I think you have to start building the frameworks globally to make progress. I've seen encouraging progress. When the G7 happened in Hiroshima, I think it was a good start. You've seen more progress. The UK AI Summit last week, the administration here, the White House has been leading the way as well. And I saw good, encouraging announcements even yesterday for US and China to start having a dialogue on AI.
Alphabet CEO there, Sundar Pichai, speaking with Bloomberg at the APEC summit. Now, as well as opening a dialogue over AI, the Biden and Xi meeting marked progress in restoring high-level military communications in efforts to combat fentanyl. But how much progress was actually made? Terry Haines, founder of Pangea Policy, says agreements shouldn't be overstated, calling them, quote, diplomatic bonbons, feel-good, sweet ephemera already telegraphed in advance. Terry Haines, founder of Pangea Policy, joins us now. I love that. Diplomatic bonbons. It's getting me hungry here at almost 11 a.m. Yet to have breakfast, so you can tell why. But Terry, tell me, this was billed as a game changer. Why wasn't it?
Well, fundamentally, because they haven't been talking in so long, Danny, and you need to start somewhere. So I'll give them that. But for markets, I think it was, even though not much was expected, it was nonetheless disappointing and brought everybody back to the realistic. Was there anything on trade? No, not at all. Was there any common cause between the United States and China to lower geopolitical risk? Mutual efforts for the Middle East, mutual efforts for Ukraine, et cetera? No, at least not on the surface. Will there be a better China business climate for companies? I think almost certainly not. It's been an unfriendlier climate, not just for United States companies, but even for Chinese companies. And we could all ask Jack Ma about how he's feeling about that this morning. But we're in a world where you've got the Chinese Communist Party overlaid on every institution, economic and otherwise, it's going to be very hard to make meaningful changes that will last and restore business confidence in China. Finally, on AI, since you ran that clip, I would say, the most important thing that President Biden said in the summit in public was not the D word that we all talked about yesterday, but it was in reference to AI. And he said that he would work with China where our interests coincide, quote unquote. That is the language of a competitor, of course, but anybody that's expecting the U.S. and China to make broad common cause on AI just got told that they probably won't.
I mean, Terry, I'm crying in my cups here because there's nothing to take share there at all. It may as well, Larry and Mr. Schwartzman may as well not bother to turn up at dinner. I mean, they got the golden ticket. They got to go to dinner with Xi. Now, I'm amazed because Xi Jinping has eradicated wealth management, disgorged tech, emaciated housing. He's gone to war with Apple. Why would you believe that he's going to have heartwarming steps to attract foreign capital?
Well, I wouldn't, certainly.
Do you think we should take that at face? I mean, I'm being slightly disingenuous, but what I am saying is history since he was last here does not bode well for a heartwarming welcome to foreign capital.
Well, you're being Irish, and I'm Irish American, so that we understand each other. But no, I wouldn't take any of it at face value, and that is no disrespect to President Xi. It's just that the statements for consumption for business community, for the American community, all the rest, are really undercut by China's actions. One of the other things President Xi also said was that, and this is a quote, China will never pursue hegemony or expansion, will never impose its will on others, does not seek spheres of influence, and will not fight a Cold War or a hot war with anyone. Mm-hmm. Well, you can run that with any fact checker around and, you'd get a resounding false. So, the business community shouldn't, and I think probably doesn't, on balance, take heart that there's going to be any major change, negative FDI or not.
Well, President Biden's also Irish American. Maybe deep down he's thinking the same thing, Terry. And you mentioned some of these high-level things they didn't have an agreement on: Ukraine, Iran, Taiwan, North Korea, trade tariffs, rare earth metals. If they didn't do that here, do you abandon hopes that there are agreements on some of these top-level issues?
No, I wouldn't abandon hope, but I would expect that if that's going to take a lot of time and a lot of effort, and there's a lot hanging out, not just on the United States side, more obvious to us today with 2024 elections and the like, but also in China. The most important Chinese meetings, Communist Party meetings, the third plenum, has not happened yet. It was supposed to happen before the end of the year. There's been a lot of speculation that it was going to be delayed until after the Xi Jinping-Biden meeting. So there's going to be a lot of heartwarming tests to follow the heartwarming words, and the business community in the United States will see very quickly, I think, whether or not there's anything backing up those words.
Okay, well, actions louder than words. That's the motto, isn't it? Terry, thank you very much. Terry Haines, making sense of a week in global politics. Quick snapshot of equities for you. We're in the green. Will that endure? Bank of America's Michael Hartnett, Danny, lovely note says, fade this epic stock rally, and a bigger drop in bond yields would trigger a bearish risk event, according to Bank of America. Right now, the money is flowing in to equities.
This is Bloomberg Brief. I'm Danny Berger in London. Manish Cranny is in New York. Let's get you set up for your trading day this Friday and a look at what's ahead. We're going to get U.S. housing starts and building permits at 8:30 a.m. Eastern Time, plus Fed speak from Collins, Barr, Daly, and Goolsbee. We've also had ECB officials speak, but we're going to hear more from Nagel and Wunsch from the Frankfurt European Banking Congress. And President Biden holds a bilateral meeting with his Mexican counterpart at 1 p.m. Eastern. Man, it's already been a crazy week. We've had a lot of data. We had CPI, which really fueled things. We had some weaker home building data, for example, yesterday. We had the weaker jobs data. And it really has ignited this rate cut narrative, which is also igniting bonds and igniting the flows into stocks.
Yeah, but then this goes back to Hartnett's note from Bank of America, where he says, yes, we're down 26 basis points in U.S. Treasuries. The Bund, European markets are now talking about 100 basis points of cuts from the ECB next year. So you're seeing these yields drop this morning. You've got your 10-year gilts. Retail sales are softer there. So the narrative for the bond market is building to be more bullish. There's no doubt about that. But what if we do see a collapse in yields? And this is what Hartnett propositions. A real collapse in yield, a much bigger collapse in yield, would be something that would trigger a bearish risk event. Stephen Major must be sitting happy on a Friday. He must be just sitting back, kicking back and going, ooh, I got that so right at the moment.
You know who else is probably feeling very good right now? UATA, the MOF, Japan. Yeah. This is exactly what they wanted, isn't it? We talked about the idea that by tweaking some of the yield curve, upper bands, lower bands, whatever you have it, that they were essentially betting that there would be a global bond market rally. They've been given that gift. We're talking about this in the commercial break. Yen now back below 150.
Yes, and that's exactly it. We're down 1% for the day. If you look at the 5 day, the dollar's had a tough old week as well. The question you need to ask yourself there is obviously we're down 1.4% for the week on dollar yen. Well, of course, the Bank of Japan might have been gifted that rally, but we saw the Fed, they've been gifted this bond rally, but that, of course, has implications for FCOM.
Yep, it's very true. Is it too loose? Does it undo the Fed's work? All right, that's it for us on this Friday.